We'll review the 4 basic financial statements from accounting principles courses. You begin with the income statement, statement of shareholders' equity, and in accounting principles 2, you learn that there could be another statement, a statement of changes to retained earnings, and retained earnings is a component of equity for corporations, as opposed to just a sole proprietorship capital account. Then there's the balance sheet and the statement of cash flow. So we'll take a look at each one of these. The income statement, this is considered a change statement. It summarizes why and how net income or loss contributed to a change in retained earnings during the period, or a change in your equity, because you do the income statement first and then you need that number to do your equity statement. And when we talk about a change statement, that focuses on how you represent the dates on this statement. It's for a period of time. Sometimes called the profit and loss statement, and you learned in your accounting principles courses there is a single step and a multi-step income statement. So this will look at the multi-step format. You start with net sales, subtract your cost of inventory sales or your cost of goods sold to give you a gross profit. But gross profit is not net income. Then on a multi-step, you must break out different types of expenses. Your selling expenses, your G&A expenses, and that's your operating expenses or your operating income. But you can, as a company, make other sources of income and have other types of expenses which must also be shown separately. This is for full disclosures to the users of your financial statements so they can understand what is in net income, where it came from, what came from general operating, recurring operations, as opposed to other income. It's much more informative. So then the second statement, of course, is the statement of shareholders' equity. This also is a change statement. And remember, this is how you represent the date on this statement for a period of time. It summarizes sources of changes to permanent shareholders' equity. And in your first accounting principles course, you just focus on a sole proprietorship with a capital account. But then in your second semester, when you're introduced to corporations, then we look at shareholders' equity instead of just a capital account, which has an additional component or an additional account called retained earnings. Statement of shareholders' equity, it only shows the net effect of earnings. You don't want to write out revenues and expenses on this statement because you already showed it on your income statement. So there are 2 components of equity. You have contributed capital and internally generated capital. And this T account is going to represent what is internally generated. But for the contributed capital, think of owners' contributions. For a corporation, that's stock. And in your accounting principles courses, you were introduced to the basics of how stock must be recorded at its par value, and excess, of course, goes into a paid-in capital account. Then for your internally generated capital, it's an account called retained earnings. Net income increases retained earnings. Net loss decreases it. And dividends, as you learned in accounting principles, is a withdrawal. It's a return of equity to your shareholders or your owners. And then, of course, this is a permanent account, so you'll have an ending balance. And the statement shows what happens on that. Third one we're going to look at is the statement of cash flows. This is also a change statement, a summary of transactions that cause cash to change during the period. Now, usually you would do your balance sheet first because you're looking at what the beginning cash was, what the ending cash was, and that goes on the statement of cash flows. It's really just a reconciliation of what happened to cash, and it must be shown operating, investing, and financing. Operating, those are going to be your current assets and current liabilities. Another way to remember it is anything to do with net income. So if you're looking at something that happened, it's a revenue, an expense, a gain or a loss, it's operating. Investing, that is the cash flows for buying and selling long-term assets. However, if you have a gain or a loss, that component would have been in operating. And then financing, long-term liabilities and equity. How do I finance my operations? Through equity or debt. And the fourth one we'll look at is the balance sheet. This is not a change statement. This is a position statement. It presents an organized list of assets, liabilities, and equity at any particular point in time. So when we say change statement, it's how the date is represented on that statement. And when we say a position statement, it's how the date is represented on the balance sheet. A classification is required by GAAP. You have to divide it into meaningful categories, and it is shown in the order of liquidity for your assets. This will just briefly go over what goes into the classification if it's current or if it's long-term. It's within 1 year of the operating cycle, whichever is longer. That's what you need to remember. What is the operating cycle? Well, it's the period of time you need to convert your cash to raw materials to finished product, the finished product to receivables, and then finally collection of cash for those receivables. So the operating cycle is from the time you initially had a cash outflow until you collect for those. For most companies, it is less than 1 year, although an operating cycle can be longer. And with liabilities, this also must be classified current and long-term. So looking at a balance sheet, the entire balance sheet example we're going to look at is a little too large for one screen, so this is just the asset side. Current assets and long-term assets. Long-term assets are then broken down into investments in other companies, property, plant, and equipment, and then you could have intangible assets after this. For total assets, for this example, is 270. Now on the next screen, we'll look at the other side of the balance sheet, which has to be broken out current liabilities and long-term liabilities, and then shareholders' equity must disclose to your users what goes into everything. That's why a classification is so important of the balance sheet. Notice total liabilities and equity equals your assets, shown on the prior screen. So again, your basic 4 financial statements, just a review, and they really should be done in this order. You do the income statement first because you can't do the statement of shareholders' equity until you know what net income is. And you can't complete your balance sheet until you know what your ending equity amount is. And we called that your first semester of accounting principles, what your ending capital was. But now with a corporation, we look at shareholders' equity. And then finally, from the balance sheet, you would have enough information from a comparative balance sheet to perform your statement of cash flows. And that is a review.